Hey, what's up everybody? This is Unravel, where knowledge is power. Trying to enjoy an upfront investment? Bonds might be a very good option. Let's dig deep into the deal to explore the mechanism of bonds and how they provide an opportunity for an investment. Although bonds are a well-known investing approach, they still pose a great deal of confusion among investors. To put it simply, a bond is a particular type of loan issued by a specific company or government to an investor. The investor gets paid interest on their investment by the government or company. Various bonds are issued by companies or governments. They are issued keeping in mind the fund requirements, new projects and expenses. An investor can benefit by storing spare funds in this asset and in the process make additional income out of it. There are plenty of options for investment, including stocks and trading, but bonds offer relatively low risk. Returns from stocks depend on the fluctuating market variables. As a result, are quite unpredictable. On the other hand, bonds offer fixed interest payments regularly, along with the original investment at maturity. Let's better understand how the bond market works with an example. A company named Conitec wants to build a new technology plant in New York. To collect the required funds, they issue bonds of $2,000 with a tenure of 12 years. Conitec agrees to pay 5% annual interest to their investors on the bonds issued. This is also known as the coupon rate. For each bond, investors will get an interest of $100 every year till the bond reaches maturity. At maturity, Conitec will also return the principal amount of $2,000 per bond. To summarize, Conitec can raise funds to start their new tech plant, and investors in return get interest payments annually throughout the life of the bond, in addition to the original invested amount. The deal brings promising mutual benefits to both parties. Although bonds are considered much more reliable compared to owning stocks, they hold their own potential risk. One of them being the default risk associated with bonds. It's the risk associated with paying back of principal amount by the issuer. Generally, bonds with high default risk come with high coupon rates. Typically, the percentage of default risk is linked with the financial stability of the bond issuer. Bonds issued by the government are considered more financially stable and therefore have low coupon rates. On the other hand, corporates are likely to be considered less financially stable than the government. Therefore, bonds issued by them are linked with high default risk and high coupon rates comparatively. Bonds are quite reliable and an easy source of generating income. One of the risks we discussed was default risk associated with bonds, where the company defaults to pay the principal amount. Another type of risk is face interest risk. If you as an investor wanted to get out of your debt agreement with the company, you could sell your bond to a secondary investor. The investor would pay you for the bond and then receive your future interest payments in your place. The fascinating thing, however, is that the market value of the bond, meaning the price at which you could sell it, changes over time. There can be three situations in such a scenario. Redemption at par value, when the redemption is done at the same value at which the bond was issued, also known as face value. Redemption at discounted price. As the name suggests, when the bond is redeemed at a price lower than the face value. Redemption at premium, when the bonds are redeemed at a higher value than the face value. A bond has a negative relationship with the interest rates being paid by other companies in the market. Let's assume you buy a government bond for $1,000 that pays 4% once a year. A month down the road, the government too issues more bonds, which will pay a higher interest rate of 5% on all future bonds. These new bonds would decrease the market value of the $1,000 bond issued initially, because for the same $1,000, you're getting a better coupon rate. This means that if you ever wanted to resell your bond to someone, you'd have to offer it at a discounted price, given that your bond is less attractive than the bond offering 5%. This would be a case of redemption at a discounted price. On the other hand, the flip side is also true. If you buy a bond and interest rates go down, your bond will become more valuable because it now offers a higher interest rate. Please note that all of this happens if you redeem your bond before maturity. Otherwise, you get the face value returned on maturity. An intelligent investor is usually combining both bonds and stocks in the portfolio. Bonds offer great reliability to investors with fewer risks compared to stocks. It enables one to generate good income without losing original investment. One can go for government or corporate issued bonds. Be sure to analyze the coupon rate and predict the rate of risk before investing.